And today we are here to make money for investors.
Essentially, nothing much changes in the business, but the market valuations are. How was the experience being a CEO, being a head of research, and then transitioning into a CIO of the same firm?
So 12 to 18 months will have its own ups and downs. There will be sectoral realignment, there will be sectoral reallocation, etc.
So, which sectors do you think are going to perform well in the coming, say, 1 to 3 years, and which sectors would you prefer to stay away from? You could give me just top two. We are hearing a lot of news about the US elections that is coming down the line.
My friend, the advice that I want to give to everyone is
Today we have the privilege of speaking with Mr. Umeshkumar Mehta, CIO, with over 25 years of experience in Indian equity markets. Mr. Umeshkumar has played a pivotal role in shaping investment strategies and managing assets across diverse portfolios. His deep knowledge of financial markets combined with a data-driven approach and lessons drawn from market history has made him a respected leader in the industry. He's been with the Samco group for the past 15 years, where he previously served as CEO and as the head of research. Welcome to the podcast, sir. It's my pleasure to have this conversation with you. So let me get on to the question. So I would like to start from the beginning. So you've had an impressive career spanning over 2 decades in the industry. So how has it shaped your approach towards investing, and if you could walk us through the journey that you've had?
so actually it all started and it starts on the dining table. So I basically come from Marwadi family, and 10th standard Umeshkumar Mehta, so roaring bull market, that was my beginning starting point. And the journey begins with a quest to make money from stock market, that personal quest. And then slowly and steadily, after I qualified CA, MBA, then I worked for some time, and then the bull market power was there, was making money. 2009 was the biggest trigger when markets was losing money. We also gave up so much of the profit. That was my best year, because that was a time when I was able to ponder, when I was able to read, get into my old study room and get in all those books which was necessary to get the learning, because no one teaches you. Either it is a self experience, or you learn from all those people who have already done, and there are so many great investors, traders, psychologists to learn from. So I think that was the biggest moment, and thereafter I think the journey began. Then I joined professionally as head of research at Samco Securities, and then steadily over here on mutual fund as a CIO.
So how was the experience being a CEO, being a head of research, and then transitioning into a CIO of the same firm? How has the transition been?
See, when you are on the research side, you are an absolute investor. You think from individual stock point of view, you think that you want to maximize the gain. But when you are on the asset management side, you have to think a complete perspective, from a portfolio perspective. That is a bigger, it's a challenge. Thinking from entire portfolio point of view. So I think we have learned, and I've also gained a lot over this last 2.5-3 years. Actually, portfolio management is altogether a different set of skill rather than individual stock pickers, right? So I think the journey was a full circle, and today we are here to make money for investors.
So looking back at your career, so is there an investment decision that you're proud of, and are there any investment decisions that you regret taking?
See, when I was at research, and I did this research extensively in the entire market. There were 1,800 stocks in NSE, and I remember back in 2014-15 odd, when we were setting up our discount broking platform. That time, when I was looking at the entire market, it took almost 4-5 months. I was able to identify great stocks, and today also when I look back, your Solar Industries, Vinati Organics, PI Industries, and all these also form part of my portfolio prior to joining mutual fund. So I think that learning that you have to look at the entire space rather than look at a particular sector or a stock. If we look at that, I think that itself will give us an insight, what are the kind of stocks and sectors which has the probability to make money.
Correct. So my next question is about the popular Hexashield framework. I know we've heard a lot about this framework that even you've talked about in other channels. So could you please elaborate on what it is and how it has helped when it comes to your investment strategies, and how is it different from other risk mitigation measures?
Correct. So Hexashield framework identifies and it is an unbiased approach to identify quality of a businesses. So what we mean by quality, earning variation should not be there. Obviously debt equity ratio, return on equity, your return on capital employed, your pricing power, corporate governance, etc. So all those things gets captured through our filtered through our Hexashield framework. It's like a complete body checkup. If all our moving parts are working fine, so that means we are healthy. So this is what Hexashield framework identifies, that look, this is a quality business or a quality pool of stocks. Then what to buy, when to buy, how much to buy is altogether a different ball of game. But yeah, Hexashield kept our focus clear that look, this is where the quality space is. You should consider for investors.
Got it. So given the framework's focus on risk, so which sectors do you think are going to perform well in the coming, say, 1 to 3 years, and which sectors would you prefer to stay away from? If you could give me just top 2.
Yeah. See, today market, your 2000 listed stocks in NSE 2100. If we look at it, there are some 140 odd or 150 odd sectors, industries or themes that are moving around, and they are driving the entire economy. So as such, traditionally we have heard private sector bank, consumers, pharma, but market is far more deeper. Market has got so many moving parts. So currently what is moving and currently what seems to be will keep on for some time is your heavy equipment manufacturing, your electrical, your power, and even for that matter defense. Two-wheeler is currently doing a lot, but that can little slow down. So these are some of the sectors and names which people have in the past unheard. They traditionally have looked at pharma, etc., banks, but there are so many, there is so much there in the market for investors to explore. And some other thing will keep on moving, and therefore it's our ability to identify, what's moving inside the market is the real crux. When you do data analytics day in and day out on a real-time basis, then only you will be able to get through the entire market of 2000 or for that matter 4000 stocks. As I told you, my experience in 2013-14, when we look at the entire market, then and only then we will be able to figure it out. Look, these are the things that can move. So similarly, on the mutual fund side also we do the same thing. We scan the entire market and then find opportunities where there is a maximum opportunity for wealth creation.
So are there any sectors that we should be cautious about, we should stay away from in some case?
See, ideally it all depends on who as investor I am talking to. If I am a growth investor, probably I will not touch your private banks, because the whole world is saying that banking sector, private sector banks for that matter are. But if I am a value investor, probably I will look at such whole set of things that have not moved and are likely to move and have margin of safety. So basically it is all about style, whom you are talking to. And
so in an increasingly institutionalized market, how do you discover new market investment avenues, say particular stock or particular sector? How do you come to that conclusion in a quick time span?
Yes, exactly. So what we run, we have models. We have developed various models, earnings model, earnings momentum model, price action momentum models, etc. So those models are well tested, and we have tested this since last 15-20 years.
Okay.
So when we run this algorithm across the market all the time, it keeps on throwing opportunities for us. It can be from various sectors. So let me give you one example, and it will take 2 minutes for this to understand. See, traditionally, if you and I, we are investor and we have to invest a company, if we want to own that company, we will not probably invest in a company which is which is a contract manufacturer of, say, television, right? Now, gross margin is, say, 300 rupees per piece. So if I manufacture for someone like LG, Samsung, I will get 300 rupees per piece gross margin. I have to pay for salaries, labors, etc. So we will not invest in this kind of business. But today, from a stock market perspective, if we are immune to, or if we shut our eyes in this type of businesses, we have probably lost a multi-bagger opportunities. So companies like PG Electroplast, companies like Dixon, they are the ones who are working at wafer thin margin, but see the kind of wealth they have created. So when we look from a traditional lens, what 10, 15 years ago how markets were and how today markets are, I think there is a dramatic change in which how we have to look market, how we have to analyze market. I think it's all about data. We have to effectively crunch data to identify which are the likely moving winning stocks going forward.
So we are hearing a lot of news about the US elections that is coming down the line. How do you think it's going to affect the Indian markets, and is it going to be a deal breaker for us?
See, at times it will be only headlines, etc. But I don't think serious investors will pull in and pull out their money unless the outcome is known. So there may be a lot of noise, etc. But it is only on 4th or 5th November when people will really know what is the outcome. The outcome will come sometime in the last week of November.
So with the interest rate cuts expected, so do you believe that momentum strategy is likely to play out? Is that a pro or a con to the momentum strategy?
See, whether or not interest rate does get they get reduced or not reduced, momentum as a strategy is immune to everything. See, what is momentum? Momentum is you are buying stocks which are in action, which are in momentum, and you are selling which are not. So today it can be value, it can be growth, it can be a whole lot of other things. Your ability is that our system should be able to identify stocks which are moving, whichever be it, whichever sector be it,
correct,
whichever investment philosophy be it. So this is how I think momentum is a evergreen as a strategy, because whatever is working will get captured through momentum.
So can I say momentum is your favorite strategy of all the other strategies out there?
Actually, although we have given names, etc., but if you look at the fundamentals, the fundamental of the strategy is that you are buying winners. In a class of, say, first standard, there is a chap who comes first in the class, and probably second standard also he comes first or second. So we are betting on this child that by 10th standard he will still be in the top category. Not necessarily that he will always be, but the probability is most likely, and therefore I think momentum is all that you get on the best people, the best teams, the best companies.
Got it. So the Indian markets have been on a strong rally, even when the global cues are not really favorable. From your perspective, what's driving this rally? Is it investor sentimental, or is it strong fundamentals, or is it a mix of both? Or
actually, there are so many moving parts that are in favor of India. So let me go back to US history. So after World War II, US was a major beneficiary because it was not impacted, and therefore next 10-15 years USA was growing at 6-7%. So currently China +1 or whatever we may call COVID, etc. So same thing is happening. So what US economy was going through in 50s and 60s, we are also going through the same thing, because people don't want to go to China, etc. And therefore we are gaining that market share. COVID, etc. Europe is really not thriving. So we are the beneficiary. We have the population, and we are growing at 6-7%. So we are going to make a lot of money, wealth from stock market perspective. Investors will keep on flocking their money, bringing their money to Indian market, because which other economy is growing at 6-7%? No one. So probably you are growing at the fastest rate. So long as this economy is growing, my friend, the advice that I want to give to everyone is keep your rates down and invest. The review period has to be annual. Just look at the annual when the finance minister gives out the forecast that okay, economy is growing at 6.5-7%. That's fine. We should not be worried, and this growth rate will be there for next 8-10 years. And I think massive wealth will get created rather than looking at here and there noise, which sector, etc. I think for investors it has to be one single number. If my economy is growing, I have to remain invested in Indian equities.
So, how do you foresee the next 12 to 18 months time period?
So 12 to 18 months will have its own ups and downs. There will be sectoral realignment, there will be sectoral reallocation, etc. We will have some cyclicality in some of the stocks and sectors. Maybe automobile will undergo some cyclicality. But I think broadly we will be in that bull market phase. But yeah, it is possible that from an index perspective, we may not be able to show that kind of fancy returns. But I think at an aggregate level, the markets will be higher in next 15, 18 months, 2 years.
And obviously GDP is going to grow up as well.
Yeah.
So now I want to talk about the NFO that's coming out. It's our Samco multi-cap fund. So what investment strategy have we is behind the multi-cap fund, and how is it different from other multi-caps in the sector?
Correct. Good question. So in multi-cap, currently the industry is working with a 3-in-1 strategy. Because the index, the underlying index is also same. The underlying index is 50% large cap, 25% mid, 25% small. So if you map the entire portfolio for everyone, it's largely 45-50% large cap and balance is equally some plus minus mid and small. So this is what the multi-cap category is. But mind you, multi-cap category is the fastest growing category. It has grown in last 3 years at 84%, and probably small cap category has grown lesser than that, around 49-50%. So by far investors love this strategy because there is a mandate that you have to compulsory invest 25, this much in this thing. So this is the beauty of this category. So now this being the case, what the strategy that we follow will be a 4-in-1 strategy, wherein instead of putting 50% in large cap, we will put only 25%. And this 25% of large cap we will shift in the micro cap. So micro cap has its own potential. So a lakh rupee invested in 2005 in micro cap has become 24 lakhs, and in large cap it is 12 lakhs. So this is where the alpha will get generated when we invest in micro cap. So this is our first unique proposition. Second unique proposition is we will manage it dynamically according to market condition. If market starts falling or it enters into bear market, and someday it can, no one can predict. So then this 25% micro cap will get shifted into large cap, and my large cap will be 50%. This we will hedge because hedging facility will be available, and some portion of my mid cap will also hedging instrument will be available. So on an average 55-60% of my portfolio can be hedged, and this hedging mechanism will have drawdown protection also. So on an average we believe that we will be able to generate far more higher alpha than the underlying benchmark for the category.
So do you think it's an added advantage to the investors who are investing into
added advantage? Maybe, obviously yes, because now you have full spectrum of all caps in your portfolio. And the stocks that you have are probably have earnings momentum, etc., price action momentum. So you have the best portfolio of stocks across each cap, large, mid, small, micro. And if the bull market continues, obviously they will have a much balanced approach to growth rather than at times something may work, something may not work. So I think all 4 horses will fire cylinders, assuming this bull market continues, they will have the best of all 4 worlds.
Correct. Yeah, so in an environment where market fundamentals can be overshadowed by events like interest rate cuts, how do you position your portfolios? Because currently the markets are in a euphoria phase, if I could say. So if you look at recently a SME called Resourceful Automobile, it's a single Yamaha showroom owner. They filed IPO. The plan was to raise 12 CR, but they ended up winning bids for 4,700 CR. And Mama, they ended up announcing a merger with its own subsidiaries, and the market cap increased by 20,000 crores. So that such essentially nothing much changes in the business, but the market valuations are everything are going up. So in this case, so do you think the fundamentals can be overshadowed? So do you think how do you balance the portfolios? How do you make sure the portfolios are made or packed for these volatilities, these whatever is coming?
Got your point. So what you mean by say is that currently there is euphoria, lesser known companies are getting, SME companies are getting high valuations, so much of money is being paid. And historically, we have seen that when there is huge IPO euphoria, huge money comes in, that's the time, markets have also entered into their euphoria.
Easy to lose sight of fundamentals.
Correct. So people lose sight of fundamentals. I think this is one way of looking at it.
Yeah.
The second way, how we, as I told you now, we are on the asset management side, we are managing a portfolio. So our systems and processes are ready. If market tomorrow turns, we will not keep our opinions, we will not keep our egos. We will also turn our portfolio and switch and get into either debt or arbitrage mode. And that is how we will have a drawdown protection.
Okay.
So I think this is where it is. So long as the markets are going, we don't want to get into that, okay, markets are expensive, we will keep on riding the wave. But if things turn, we will also will have our opinion, we will also shift immediately. And this is how we will be. So the saying that I say to my investors and my team is, we can be wrong, but not for too long.
That's a good one. Yeah, got it. So one of the most common questions that I ask to all the fund managers, all CIOs that I talk to, is there about their personal portfolio allocation. So if you could share your personal portfolio allocation, that'd be great, percentage based.
So obviously, prior to I joined mutual fund 3 years ago. I had sold all my portfolio. Okay. Currently, all my money is invested in 5 of my schemes, and 5 of the schemes that we run as a fund house.
In the game, you have skin in the game.
My actually body in the game. And second, I also have a substantial investment in my AMC as a company. So I am also a shareholder, and therefore I know that I have to work harder for this AMC to grow well, so that eventually I also create wealth, and at the same time my investors also have to make far more money than only this magical this chain reaction will happen. So yeah, I think AMC is all about everything is there in my entire house is in now AMC.
So if you could give a percentage wise in equity, real estate, and
so everything is in equity.
That's it.
Everything is in equity.
Okay, got it.
So real estate is there in my wife's name. I don't want to call it, but for me, all my wealth is in equity in Indian markets.
Got it. So when it comes to retail investors, how do you think they should position their portfolios at this, say their equity portfolios?
So now I will. This is this dramatic view that I have, and I hope all our retail investors can get through this. See, today retail investors are colored with so many noise, so many, there is media, there is whole lot of world out, there is mobile in his hand, and therefore lot of information is getting into his day in and day out. Sometimes the information is good, bad, etc., but something or the other is there. But if he just keeps his eyes closed, and if he just looks at 10 years down the line, like if I don't want money for next 10 years, either I am working or I am a businessman, or even if I am retired, if my age is 65, probably my average, I will live around 80, 85. So for next 10 years, even I don't require money. So remain fully invested to equities through any of the mutual fund schemes, etc., growth oriented schemes, lot of money will be made. Rather than, getting afraid, oh my God, there is risk, there is volatility. Volatility is not a risk. Probably when markets are volatile, so markets will have its own correction. But our stomach should not get disturbed, right? Because markets are there. Yeah. So our aim is for next 10 years, and I think a lot of money will get created just by this basic mantra that I don't want money for next 10 years. I am investing in equities, I am investing in India. So long as India is growing at 6.5%, 7%, 8%, I will not move my money out from equity. Even if there is correction by 20, 30%, sometimes global event can go wrong, I will probably put more money rather than thinking that I want to take my money out. I think this mentality, this thought process, day one, today in bull market is very important, because this is how only serious wealth will get created.
Great. So one last question. So is it okay, should we have international allocation, namely say US allocation in the portfolio?
I think it's ideal, because USA is one of the pioneers in technology, innovation, etc. It's a great capitalist country, and it is worthwhile. If someone wants to have diversification, I think USA is a good, some of the tech companies are good way of diversification.
So it was very lovely, very informative talking to you. Thank you so much for your
Thank
time.
you.
It was my pleasure.